This was not debated for weeks. It was not slowed down by public outrage. It was passed quietly in less than 24 hours. And starting Monday, the rules that govern your money inside the banking system change. Not next year, not someday, Monday. If you use a bank, this affects you. The speed alone should make you uncomfortable. When lawmakers and regulators move this fast, it is never for convenience. It is for control, risk containment, and damage prevention. And the damage they are trying to prevent is not theoretical. It is already happening behind the scenes. Banks are under stress, liquidity is tighter than headlines admit, and confidence, the one thing a banking system cannot lose, is fragile right now. Here is what makes this new banking rule different. It does not target criminals. It does not target reckless traders. It targets normal accounts, everyday deposits, ordinary transfers, the kind of activity most people never think twice about. The rule quietly expands what banks are allowed to delay, review, and restrict when it comes to customer funds. And once a rule like this exists, it does not get smaller. It only gets used more often. Think about how banks really operate. Your money does not sit in a vault with your name on it. It is part of a system that relies on constant movement. Deposits come in, loans go out, markets provide liquidity. When something breaks in that chain, even temporarily, banks need tools to slow everything down. This rule gives them exactly that. A legal pause button. Officials are calling it a technical adjustment, a procedural safeguard. But those are comforting words for a very real shift in power. Starting Monday, banks gain broader discretion to decide when transactions look risky, unusual, or disruptive. That sounds reasonable until you realize who defines those terms. The bank does, not you, not a judge, not a regulator in real time. Imagine a scenario where market volatility spikes overnight. Bond yields jump. A major institution wobbles. Social media starts buzzing about bank exposure. You wake up and decide to move some money, just to be safe. That is when this rule matters, because under the new framework, the bank can slow that decision down, review it, hold it, not because you did anything wrong, but because the system needs stability. This is not about panic, it is about preparation. The banking system has learned from past crises. In 2008, they lacked the authority to act fast enough. During recent bank failures, they lacked consistency. This rule closes that gap. It centralizes response. It prioritizes system survival over individual convenience. And here is the part most people miss. Rules passed this fast are usually reactive. Something already broke, something already scared the people at the top. They are not telling you what it was, but they are telling you how they plan to handle it next time. And next time could be sooner than you think. Because once a rule like this goes live, it becomes part of the new normal. Banks adjust their algorithms. Compliance teams rewrite thresholds. Customer service scripts change, and the relationship between you and your money shifts just a little more away from instant access and toward conditional permission. This does not mean your money disappears. It means access becomes situational. It means timing matters. It means awareness matters. And it means understanding the system you are in matters more than ever right now becomes the difference between confidence and confusion. Most people assume banking rules only matter during a crisis, but in reality, they are designed for the moments just before one. This rule is not meant for calm markets. It is meant for stress. It is meant for volatility. It is meant for situations where too many people want access to their money at the same time. Banks do not fear losses as much as they fear speed. Losses can be managed. Speed cannot. When withdrawals accelerate, when transfers surge, when deposits start moving all at once, the system strains. That is where this new rule fits in perfectly. It gives banks breathing room. It allows them to slow momentum without declaring an emergency. No sirens, no headlines, just quiet friction. From the outside, nothing looks wrong. Your app still opens, your balance still shows. But behind the screen, the decision-making process has changed. Transactions that once cleared automatically may now pass through additional filter. RS. Amounts that were once routine may trigger reviews. Timing that was once predictable may now be flexible. And flexibility in banking always benefits the institution first. This is why the rule passed so quickly. Speed signals urgency, and urgency signals fear. Regulators do not rush unless they believe conditions can deteriorate fast. Rising interest rates have already exposed cracks. Commercial real estate is under pressure. Government debt issuance is accelerating. Global capital is moving differently than it did even a year ago. All of this flows through banks. People often ask why these changes are never clearly explained. The answer is simple. Transparency can cause behavior changes. If everyone understood exactly when and how access could be delayed, people would act differently. They would move earlier. They would diversify faster. They would reduce exposure. And that behavior itself would create the very stress the rule is designed to prevent. So instead, the messaging stays vague. Technical update. Risk management enhancement. Alignment with international standards. None of those phrases tell you what it feels like to need access and be told to wait. And that is the real impact of this rule. Not confiscation, not collapse. Delay is powerful. Delay changes decisions. Delay calms systems. Delay frustrates individuals. And delay buys time for institutions to stabilize their positions. This is not a theory. It has been used before in different forms in different countries under different names. The pattern is always the same. Quiet implementation, broad authority, gradual normalization. What makes this moment different is how fast it arrived. Less than 24 hours from approval to reality. That suggests the framework was already written, already tested, already agreed upon. All that was missing was the trigger to activate it. Whatever that trigger was, it happened recently. And once you see it that way, the rule stops looking like a random update and starts looking like a signal. A signal that banks expect more volatility, more pressure, more moments where stability matters more than speed. And that expectation alone should make anyone paying attention pause and rethink how they interact with the system going forward. Because when rules change this quickly, they are telling you something without saying it directly. They are telling you that the era of effortless access is fading. That convenience was a luxury of stability, and stability is no longer guaranteed in the way it once was. This does not mean panic. It means strategy. It means understanding where your exposure lives. It means recognizing that money in a bank is not the same as money in your control. It means asking questions you did not need to ask before. How quickly can I access funds if I need them? What happens during market stress? What assumptions am I making about availability that may no longer hold? Banks are not villains in this story. They are systems. Under pressure. They are adapting to a world where shocks travel faster, capital moves instantly, and confidence can vanish in hours. This rule is their seatbelt. Uncomfortable, restrictive, but designed to keep the structure intact during impact. The real mistake would be ignoring it, assuming it does not apply to you because your balances are modest or your activity is normal. Systemic rules do not discriminate by intent. They apply by pattern. And patterns change when conditions change. Starting Monday, nothing dramatic may happen. In fact, the most likely outcome is that nothing appears different at all. And that is exactly the point. The most effective controls are invisible until they are needed. But once they are needed, they are already in place, already legal, already normalized. So pay attention, not with fear, but with clarity. Understand the rules of the system you are operating in. Because the rules just shifted, quietly, quickly, and decisively. And when money and access are involved, those shifts always matter more than most people realize. In the end, this is not about a single rule or a single Monday. It is about a broader trend. More control, more oversight, more friction during stress, and less assumption that access will always be instant simply because it always has been before. History shows that financial systems do not change gradually when they are under pressure. They change suddenly. This was sudden, and it was intentional. The people who do best in these environments are not the ones who panic first. They are the ones who understand the structure, anticipate the constraints, and position themselves accordingly. Awareness is not alarmism, it is preparation, and preparation is the only real advantage individuals ever have when systems begin to tighten. Because when rules are passed in less than 24 hours, it is never about the present. It is about what they see coming next.